All right, let's dive into Lululemon's latest quarter. The numbers, they were okay, but the stock, it absolutely soared. So we're going to dig into why the real story here had pretty much nothing to do with the numbers on the page.
Okay, first thing you need to know, the stock went on a tear. Right after the earnings dropped, shares shot up almost 11% in after-hours trading. I mean, that is a huge move, especially for a company that's been having a pretty tough year.
And that's the big question, right? Was the quarter really good enough to justify that kind of jump? Honestly, the short answer is not really. So what in the world was actually going on?
So here's how we're going to break this all down. We'll look at the headline numbers, then the story across different regions, and get to the real reason the stock moved. After that, we'll cover their guidance and headwinds, and then wrap it all up with our take.
All right, Section 1, the headline beat. On the surface, this looked like a pretty clean win for them.
So if you just glanced at the headlines, you'd think everything was great. Their earnings per share came in at $2.59. Wall Street was only looking for $2.21. That's a beat of over 17%. And revenue? A solid beat there too, hitting $2.6 billion. For the trading algorithms and the quick headline readers, this looked fantastic.
But as you can probably guess, those headline numbers don't tell the whole story. When you look under the hood at the different geographies, well, it's a completely different picture.
And wow, what a split. In the Americas, which is, their main market, sales were actually down 5%. But then you look at China and revenue was up a staggering 46%. It's not an exaggeration to say that their international growth is literally holding the entire company up right now.
And it's not just the U.S. sales that are a problem. Their profitability is really getting squeezed. Gross margin fell by almost 3%, and operating margin dropped even more, by 3.5%. So what's causing this? Well, it's a combo of higher tariffs and having to do more markdowns to get rid of inventory, and by the way, that inventory is still up 11% from last year. These are some serious red flags for investors.
Okay, so let's recap. The US is weak, margins are getting crushed. So why on earth did the stock rally? Well, here's the twist. The real reason, the thing that actually moved the needle, had nothing to do with Q3's numbers. It was a huge announcement about who's in charge.
It turns out CEO Calvin McDonald is stepping down. He's been at the helm since 2018, and he'll be leaving at the end of January. In the meantime, the CFO and Chief Commercial Officer are going to take over as co-CEOs, while the board looks for someone new.
And this is the absolute key to understanding that stock pop. The market didn't panic, it didn't see this as a sign of trouble. Instead, it saw it as a massive opportunity. The whole story just flipped overnight. It went from, oh no, another slow quarter of trying to fix the US, to, okay, great, a total strategic reset is coming. Investors weren't trading on what's happening now, they were betting on a brand new future. All right, so everyone's excited about this reset. But what did management actually say about the future? Well, let's look at the guidance, because they basically warned everyone that the road ahead's going to be bumpy.
And they put a big, scary number on it too. They're expecting a hit of about $210 million to their operating income for the year. That's just from tariffs and a change in a trade rule. I mean, that is an absolutely massive headwind to be flying into.
So what are they going to do about it? Well, they've got this three-step plan. 1, make better, newer products. 2, improve the shopping experience. And 3, get more efficient to absorb those tariff costs. Sounds good, right? But here's the catch. They were very clear that we won't see any real results from this stuff until sometime in 2026.
Okay, let's put it all together. What does all this mean for the stock? Here's the Talk Ticker's take on Lululemon. We're starting this off with a market perform rating. And you might be asking, why not something more exciting? Well, it's because the stock is caught in a tug of war. On one side, you have this huge positive catalyst, a new CEO coming. But on the other side, you've got these really serious problems with US sales and those shrinking margins.
So, going forward, here are the 3 things we're watching like a hawk. First and foremost, the CEO search. It is everything. After a year where the product just felt stale, they need to hire a real product genius to get the excitement back. Number 2, can they actually fix the US stores? We're talking less clutter, better products on the shelves. And third, can they stop putting everything on sale in this environment? The answers to those 3 questions will tell you exactly where this stock is headed.
And that brings us to our trade idea. With so much up in the air, maybe the smartest play isn't to bet whether the stock goes up or down, but just to bet that it's going to move a lot. This is what's known as a volatility trade.
So here's the thinking. The announcement of the new CEO is going to be a make or break moment. If they hire an absolute rock star, the stock could just take off. But if they pick someone,
uninspiring, the stock could get crushed. So a way to play this is with an options strategy, something like a long straddle. Basically, you're positioning yourself to make money if there's a huge swing, up or down, when that news hits.
So, to sum it all up, the Lululemon story isn't about the quarter they just had. It's about the future that investors are now hoping for. That CEO change basically hit the reset button and bought them some time, but you can't forget that the underlying problems are still very, very real. And of course, this is not financial advice.